This is the 2025 FOREX Trading Empire Mentorship Program, Lecture 28. The topic for this lecture is Weekly Profile, first 4-hour fair value gap. In this lecture, I'll be talking about weekly profile, which in more lectures to come, I'll be diving deep into the weekly profile and daily profiles, telling you how you can plan your week before price, having that anticipational skills of having a predefined plan before price action and an easy defined trend throughout the week or throughout the day, which in this lecture I'll be talking about daily profile. And the daily profile we're talking about is the first 4-hour fair value gap. Now, this first 4-hour fair value gap was a name I give to the weekly profile. It's also known as a trend continuation weekly profile. And in this lecture, I'll be diving deep into why is it called the first 4-hour fair value gap. Why I called it the first 4-hour fair value gap weekly profile, with the general name is the trend continuation weekly profile. So we're on the chart, and in this trend line, imagine this trend line to be a weekly trend. This is the weekly trend on a 4-hour perspective, on a 4-hour time frame. Now, on the 4-hour time frame, here's the opening price of the week, and here's the closing price of the week. Now, generally, you will see me talk about the example where price goes below the opening price, trade above the opening price, then close, which is called the open, low, high, close. Where in this example, the open is the same area as the low and the high and the close. Whenever price opens, trade to your bias, which predominantly in this example, I'm talking about in a scenario where you are anticipating an up close candle. Remember, this is vice versa to a down close. You will see price opening and trading lower on the first day of the price action, which will be on a Monday. But in this example, I'm using a bullish example, which was currently the previous week prior to this week of making this pre-recorded video. Look at trade on those trade idea and giving the example as a trade review and still defining the weekly profile. On the weekly profile, price open did not run a liquidity below the opening price. That's the meaning of this price trading higher, showing a line trading higher. It's trying to tell you that price did not run a liquidity below the opening price. Whenever price open on a Monday or on a Sunday prior to Monday, and price trades higher without running a discount liquidity, which in a scenario where you are looking for, in most scenarios, you'll be looking for price to trade below the opening price to run some sort of liquidity, some sort of sell liquidity, or a feel of an imbalance, a fair value gap. But in this example, price did not run any liquidity, price traded higher. Now, that price, like the price used to trade higher, you are identifying the first 4-hour fair value gap in it, because this is telling us that price is in a trend continuation. There's high volatility in price, which means price is going to be delivering to our target between the range of Monday, Tuesday, or Wednesday. And price is setting the tone to deliver price to our intended direction. Make sure that if price was to trade higher to run out your target, make sure your target is not being run out on Monday or the first price leg going higher. If your target was to see price to run the previous week high, you need to see this swing high form without running out the previous week high. You identify the first 4-hour fair value gap. That 4-hour fair value gap will be the fair value gap if you're looking for price to trade back to a discount between the range of Monday, because I'm calling it between a weekly profile. Price legs like this do form on Monday. When you see the price leg and there's the 4-hour fair value gap, trades above the opening price where you are anticipating an upwards candle. Remember, you are anticipating an upwards candle and price is creating a swing high like this. Then you're looking for price to retrace back to that 4 hour fair value gap. Then you look for buy and anticipate price to run to your target, which is the buy sell liquidity. And this buy sell liquidity could be previous week highs, daily high, daily buy sell liquidity, daily imbalance, whatever liquidity pool is above this 4 hour swing high. And this 4 hour swing high could be your target when using intraday entry, like the 15 minutes and the 5 minutes. This should be your first entry. Then if you're using the 1 hour for entry, then you can target your complete targets and anticipate higher prices. Now, in some example, in some weekly profile, the 4 hour will do an internal trend of creating a swing high and a swing low, then creating another swing high and a swing low, retracing to another 4 hour fair value gap. Now, this example is not that common. It's when price did not run out your intended direction and there's still potential of price trading higher. Remember, you need to have a narrative to tell you that price is actually trading higher and there's a high probability of price trading higher. When you have that narrative, then if price were to be traced back to another 4 hour fair value gap after respecting this first 4 hour fair value gap to create a new swing high, when price retraces to the 4 hour fair value gap, you'll be looking for intraday setups or you use the 1 hour shift in market structure to look for higher prices for price to run out the 4 hour high. Now, there are ways to target this. If price haven't traded to your bias or to your next drawn liquidity you identify, the buy sell liquidity, previous week high, daily fair value gap, and before this retracement, price did not run to that liquidity, then you can target that liquidity. But if price already taken out that liquidity and there's still potential of price trading higher, you need to know from the higher time frame perspective. If there's going to be another trend higher, then your target will be the 4 hour swing high. You need to be very skilled with your target. If not, you're going to be in a trend where price already exhausted and is leading to a retracement, and you're still in that trend, and it might lead to a retracement, stopping you out. So you need to make sure you have a good narrative and looking for those low hanging fruits targets. Previous week, daily swing level, and you can even use a daily fair value gap as your target, which I normally use daily fair value gap, previous day high, previous day low as a target. You're just looking for the low hanging fruits on the higher time frame so that when you're entering on the lower time frame, when you are in a trend where price might retrace on you and you are trying to manage that trade, you need to have a close target, a low hanging fruit target for you to take your profits. Then trying to hold a trade from this 4 hour swing low to target the whole weekly trend or the whole weekly expansion. So you need to look for those low hanging fruit from the 4 hour time frame, daily time frame, and previous week highs as your next draw on liquidity. So let's go to the chart. Now, you can see this is the Hero USD weekly chart. And on this weekly time frame, you can see there's no annotation on the chart. This is a blank chart. Now we are trying to determine the bias. Why I was anticipating an upwards candle. Now, you can see here's the candle I was anticipating an upwards candle. Now, what brought up the idea of me anticipating an upwards candle? The price to go for the previous week highs and the previous week high. First, price traded lower. Throughout last year, during the December contract, price traded lower. Look at sell side. Starting of this year, price traded higher. And you can see how price kept the weekly trend on a bullish trend. Going for the buy sell liquidity, price took out the buy sell liquidity. After the run of the buy sell liquidity, price did a retracement to a weekly fair value gap. After a retracement to the weekly fair value gap, price failed to close outside the fair value gap the previous week prior to this week example. Price failed to close outside the fair value gap, traded back into the weekly fair value gap, Anticipating price to run out the previous week highs, because price is now showing signal that price is expecting the weekly fair value gap. And if price were to trade through the fair value gap, then it will be an inversion fair value gap where you're looking for lower prices to the weekly order block. But price did not close outside the weekly fair value gap, traded back to the weekly fair value gap, which in a 4-hour trend, this must have been a shift in market structure. And that would lead to a complete trend higher without price even going lower below the opening price to run a sell side liquidity before trading higher. Now, in few example, price might trade lower, even go for the previous week low. But the next example, price did not do anything like that. There's a high momentum in price led to higher prices. And your target will be previous week highs, weekly highs, to price straight to your buy side liquidity. Now, going further for price to run this buy side liquidity, I'll be anticipating an up close candle till I see a run on this buy side liquidity because I'm looking at it as a trend continuation where this is just a retracement to a discount price. For you to use a fib to measure the swing low to swing high, this will be below the 50%. Price traded below the 50%, we expected the weekly fair value gap. Now I'm looking for price to trade back to a premium. And this is the buy side liquidity, premium buy side liquidity. Now on a 4-hour time frame, previous week, you can see how price traded outside the weekly fair value gap, traded back to the weekly fair value gap, did a shift in market structure, stayed inside this 4-hour fair value gap. Weekly open this week, trying to explain. Price traded higher, took out the previous week high, created a 4-hour fair value gap. You can see the first fair value gap after the opening price, which in the weekly profile with the narrative. Remember, you need to have a narrative to validate this idea before looking for a trend continuation or anticipating price to respect the first 4-hour fair value gap. In this example, the narrative was that price traded to a weekly fair value gap, failed to close below the fair value gap, traded back to the fair value gap, did a 4-hour shift in structure, prices inside the 4-hour fair value gap, and it might lead to a trend continuation to run at the previous week high. Price open, took out the previous week high, and our next draw on liquidity is to see price run the next weekly high, while within that price range, you can see there are 4-hour swing high for a low hanging fruit target, 4-hour swing high for a low hanging fruit target till price trades to our overall weekly target. Retracement to the 4-hour fair value gap to look for your buys. What's going to be your target? Next draw on liquidity. 4-hour draw on liquidity. First target will be the buy side liquidity. Buy side liquidity. And if you have to measure the retracement to use the standard deviation, your target will be the 100% mark. Now, this is a measurement of this swing high to swing low. I'm marking the 100% mark level. And you can see how price respected it before this retracement back to the order block. Going into lower time frame, pair this with your trading section, with your trading time, or with your entry time. In this lecture, I'll be going through the two entry using a higher time frame perspective, like the 1 hour for entry, and using a lower time frame, like the 15-minute and the 5 minutes. So this is the 1 hour time frame. On the 1 hour time frame, you can see price traded to the 4-hour fair value gap did a shift in market structure. During the shift in market structure, you can pay attention to this three consecutive down close candle. This three down close candle took out this swing low before trading to this high. Now, in order block perspective, we call this a breakers block. They have different types of order block. I think not that different. They just have two types of order block. They have a normal order block where price is using it as a support level, and they have a breakers block where price is using that order block for a run on opposite side liquidity before trading to do a shift in market structure, which in this example, here's the breaker. Price retrace back to the breakers. This will be your entry. The moment price trades above the breakers, you have to set your limit order at the breakers high. Remember the wick at the breakers high of the three consecutive down close candle. Set your limit order at the wick. Price retrace to the order block. Respected it. The stop loss will be at the swing low. You're anticipating higher prices for price to run the buy side liquidity. Price respected the order block. Look at the buy side liquidity. A standard deviation, one standard deviation. You can see how price delivers to the one standard deviation. You can see a simple bread and butter move, low hanging fruits as your target. Now, using a 15-minute perspective from that first 4-hour fair value gap. Now, this is between the daily range. This is on Tuesday price action. Here's the opening price on Tuesday. You can see the accumulation at the opening price. Price traded lower, took out the swing low, 15-minute shift in structure, fair value gap. Price respected the fair value gap, traded higher, failed to run the buy side liquidity because this is a 1-hour shift in structure. Retracement back to the 1-hour order block. Now, if you were to take a buy, you must have traded your stop to this swing low before price will be stopping you out at a break even. But price retraced back to the 1-hour order block. You can see there's a shift in market structure, retracement, entry, and you can see how price delivered to the buy side liquidity, which would have been your target, taking a buy from this fair value gap. Now, this first entry was prior to the London section, and this entry was the 8:30 to the 10 a.m. fair value gap entry. So if you were to take a trade from this, you must have been stopped out from the 3 a.m. fair value gap, which is this fair value gap. It's already close to the buy side liquidity. I wouldn't be looking for price to trade because this wouldn't be much of a risk to reward for me to risk a full size position on this. So personally, I wouldn't be taking this trade, which I did not actually take a trade to put a stop loss here. I did take a trade, but my stop loss was at the swing low, and I was anticipating a complete run on this buy side liquidity to trade to the 100% mark. Price the retracement back to my entry, which I wasn't stopped out because my stop loss was still at the swing low. Respected it because I was still looking at the 1-hour trend. So I kept my stop loss at the swing low, respected the other block, traded higher, look at the buy side liquidity, and traded to the 100% mark, which was actually my target. Now, we just talked about the first fair value gap and how to take advantage of the fair value gap with multiple time frames. You can either use the 1 hour, the 15 minutes, or the 5 minutes. Now, when you're using the 5 minutes, try to step a little bit higher. You can still open two charts to look at the 15 minutes and the 5 minutes because you want to see the right fair value gap and the right place to place your stop loss. There might be some internal trend in the 5 minutes, where in the 15 minutes, if you're looking at it, it's going to be a liquidity, which means you don't want your stop loss to be at that liquidity. If not, you'll be stopped out of the trade and price will trade to your bias. And it have been like the price have been doing it for a while on mostly Euro USD or currencies, mostly on currencies. And I started moving a little bit the time frame higher to look at the higher time frame perspective before moving my stop to break even. So that I can give that trade a breathing space for it to move around before actually trading to my direction. So first fair value gap, price respected it, traded higher. You can see price did not run out of previous week high or weekly high. Price did run out of previous week high, but price did not run out this weekly high, which was our weekly target. Price the retracement to the 4-hour fair value gap and other block. So this is an example where price is creating a swing high, swing low, and another swing high for you to take advantage of. But remember, you need to have a target before taking advantage of this 4-hour swing level. swing low to a swing high, retracement to the fair value gap, and you can see price retested the other block at the same level before trading, running out the previous high, 4-hour high. Price didn't actually run out the weekly high, but came close to the weekly high before the close of the week. Now moving down to the 1 hour time frame, you can see how price traded to the 4-hour fair value gap, traded higher, retracement, shifting structure, retracement back to the fair value gap. This would have been your buy, limit order, buy, stop loss at the swing low. The target should be the buy side liquidity. And you can see how price delivered completely. Now, using this trade idea for an intraday setup, this is on Friday price action. Now, on Friday price action, seeing the price open, traded lower to a 4-hour fair value gap, this would be the distribution of this would be the manipulation phase where you're anticipating price to distribute to the next draw on liquidity, which is the buy side liquidity, the 4-hour buy side liquidity. Going into those individual trading section, you're looking for an entry based off those trading section for price to trade to the buy side liquidity. So throughout this trend, this was the midnight trading. This was actually when London section during the 2 a.m. to 5 a.m. kicked in. When price retraced to this 1 hour fair value gap, and this would have been your first entry if you were to use the 1 hour as your entry. And this 1 hour fair value gap will be where you're looking for the London section to respect to run at the buy side liquidity. Remember, you need to have those multiple time frame alignment before looking for your daily bias, because your daily bias was to see price to run the buy side liquidity. Because price open traded to a 4 hour fair value gap, higher time frame perspective, looking for price to run the buy side liquidity. On the 5 minute time frame, you can see this is during the Asian section trend, price traded higher. During the London section, price traded to the 1 hour fair value gap, created a shift in market structure running at this high. This is during the London section, the 2 a.m. to the 5 a.m. So during the 2 a.m. to the 5 a.m., you can see the 3 a.m. fair value gap. This is the 3 a.m. setup. At the 3 a.m. setup, price is the retracement to the fair value gap, respected the fair value gap, traded higher. Now, there's still many instances for you to take advantage of this entry, but I'm just pointing out to the discount and the most obvious entry during the London section if you had to use the 3 a.m. to the 4 a.m. entry model. And where's your target? The 4 hour buy side liquidity. You're taking a buy, anticipating price to run the 4 hour buy side liquidity. And during this time, trading your stop are currently waiting for price to form the right swing low to a swing high before adjusting your stop for price to trade to your target. And using this weekly profile, now if you are to know which specific weekly profile to anticipate on every week, I can say that you can't tell from Sunday alone. You need to wait for Monday's price action. The point is that on Monday, you need to see the Monday price action for you to tell what weekly profile am I anticipating price to trade to. In most cases, I don't trade on Monday, but I do look at the chart on Monday to see if price is tipping his hands to me for me to look for an entry. And if price is tipping his hands to me for me to look for an entry, then I look for an entry. So on a weekly profile, you need to have a predefined bias where you are looking for an up close candle or a down close candle. Then on the weekly profile I'll be mentioning throughout this lecture, you'll be putting those pieces together and to see how the individual days are reacting to price, how is the individual days trading, for you to know where price is actually trading to and what current profile are we in. This will take times, so make sure you do your back testing on this specific example. Look for times where price trades to your bias on Monday, forms a 4 hour fair value gap. You can start by marking the first 4 hour fair value gap on every week. Then pick out the weeks where you have a bias, see how price trades to that 4-hour fair value gap. There are many ways to use the first 4-hour fair value gap of every week, but this is one of the ways to use it for a trend continuation bias, where you are anticipating price to trade higher and price did not trade to a discount liquidity before forming the 4-hour fair value gap. Now, in some cases, even if price were to trade lower, run a sell side liquidity, and still form the 4-hour fair value gap, the 4-hour fair value gap is still valid as an entry level. You just need to understand more about weekly profile to apply it correctly. Make sure you do your back testing. It's very important to do your back testing to understand this weekly profile. And you can watch this video a few times. Make sure you jot down the steps and jot down the reasons for me to look for a weekly profile and what are the characteristics of me using this weekly profile. What are the things I need to look for before using the weekly profile? First, I need to see a 4-hour fair value gap aligning with my bias where price haven't traded to my weekly bias and I'm still anticipating higher prices. If prices was at its peak high, where there's a likelihood of price retracing and money trades to take out the previous week high, I will look for a complete reversal because that is another weekly profile. And I don't want to confuse you guys, telling you guys that just look for the first 4-hour fair value gap on Monday and try to buy from it. You need to have a narrative. When you have a narrative and the weekly profile is aligned with the narrative, then you take the trades. So that is it for this lecture. See you guys in the next lecture.